Well, thank you, and it's an honor to be here this morning to be able to speak to you, and it's encouraging to see such a nice turnout this morning. So let me start this morning by telling you what I won't be speaking about. I won't be talking about the government shutdown. I won't be talking about healthcare or the potential for a new Fed chair. What I will be talking about is an agriculture outlook, so a little bit less controversial topic for the time being. Some of you may be wondering why the Fed cares about agriculture. So for a bit of background, I'll provide quickly sort of why we might be thinking about this. The Federal Reserve System is comprised of the Board of Governors in DC and the 12 reserve banks spread throughout the country. We're going on our 100th anniversary this year. If some of you are wondering, the Fed is not funded by Congress, so we are full in operation. Spread across those 12 reserve banks are branches affiliated with each district. And each branch and economists within those districts provide information and research support, policy support to bank presidents and senior management insofar as they're discussing monetary policy deliberations and bank supervision and so forth. So part of my role, when you think about the District of Kansas City, which is the district that I'm in, we cover a 7-state region, which is Nebraska, Kansas, Oklahoma, the western third of Missouri, the northern third of New Mexico, all of Colorado, and all of Wyoming. So when you think about that district, we have a large concentration in agriculture. And agriculture and energy are, in fact, two very important sectors in our district. So understanding the composition of agriculture, what it means to the labor markets, and what it means to incomes, what it means to things like GDP growth and manufacturing on a regional basis are very important. And so our bank president, Esther George, takes information that she gets from the economists, both on a national level, so the macroeconomic outlook, as well as regional information to the Federal Open Market Committee table in their discussions about monetary policy. And they each do a go-around to talk about what conditions look like, either on a national level or a regional level. So that's part of the motivation for talking about agriculture. And what I'd like to share with you this morning, to the extent possible, would like to take a look forward at what agriculture might look like for the next couple of years. Those of you that might be familiar with the sector would know that agriculture has been doing very, very well. So throughout the presentation, I would ask to keep that in mind. If there are some elements that come across as being somewhat pessimistic, just bear in mind that the last couple of years have been very, very positive. So to start out, some of this has been shared, setting the stage here with the U.S. economy continuing to advance slowly. And it was mentioned some of the numbers for GDP growth here, looking at about 1.8 to 2%, and forecasts that have ranged in the vicinity of 2 to 3% over the foreseeable future. Underlying these numbers, though, and the modest growth that we see in the economy is what I would refer to as a shift in market performance. And some of this has been discussed a little bit. When you think about the ramp up in 2008 and some of the sectors that were contributing to growth leading into 2008, a lot of this, as was talked about, came from consumer spending. The housing market was doing very, very well. But then following 2008, we saw those sectors start to decline. We saw a crash in the housing market, consumer spending fell. But then throughout 2008, it was mentioned again that crude oil prices were very, very high, commodity prices in general, and manufacturing was doing very well. The last couple of years, those sectors were doing well, but now we're starting to see those sectors plateau, and there's a reversal back to where we see some of the strength, albeit slow, coming from the housing sector and consumer spending, specifically things like durable goods, interest rate sensitive sectors, which probably isn't surprising given the current monetary policy environment. And then some of the uncertainty that's out there coming from the government spending and investment that's plagued by uncertainty these days as well. So in general, commodity prices have been falling, and this is where I'll shift into agriculture a little bit. What you can see here, going up into 2008, and then the crash in 2009 in commodity prices, this is true not just for energy commodities, but for ag commodities as well. Corn falling from almost $8 in 2008, summer of 2008, to $3 to $4 thereafter in 2009. And then you can see the run up here later. But now we've seen this plateau, and this is true across all commodities. Again, this is the Commodity Research Bureau Index meant to be fairly representative of a wide basket of commodities. And what's important to note about commodity prices, when you think about Kansas, when you think about the 10th Federal Reserve District, which is the district that we cover, is that income in this region is very, very reliant on commodity markets. And that shouldn't be surprising when you think about the composition. Think about the industries, whether if they're not directly related to ag production, they may be indirectly related as it's food processing or machinery and those sorts of things. And so what's shown in this chart is the difference between per capita income in our district, our 10th district, and the U.S. as a whole. And what I've shown here in the shaded regions are recessions. And the point that I'd like to make here, if you look especially at the early 80s, and this recession was mentioned, and also the recession in 2008 going into 2009, is think about what this difference looks like during those periods of recession. These were periods where commodity prices were quite high. So in 2008, our district income actually was quite high, but then crashed in 2009 with the fall in commodity prices. And so as you can see, the district as a whole, when you think about income, when you think about growth, is fairly reliant on commodity markets. And so the question that I would pose here this morning, keeping in mind where commodity markets have been the last few years, operating at a fairly high level but starting to see some decline, is are commodities driving a transition in U.S. agriculture? So to get at this a little bit, this is a projection that comes from USDA looking at net returns and forecasting this forward, so projections going out to 2020. I've shown it here through 2018. What's shown here, you can see here the returns on crop profits, specifically for corn and soybeans, very, very high in 2010 and 11, 2012, even despite the drought. 2013 still expected to be quite strong, but then look what happens in 2014. You see this fall, especially in corn and returns in corn. The same is true for soybeans, although to a lesser extent. So at the same time, though, what we're seeing is a difference in livestock. So the livestock sector, as opposed to the crop sector, the last couple of years has been struggling. And this is no doubt due to soaring feed costs and inadequate pasture lands because of drought and those sorts of things that are forcing feed and forage costs to go higher. Looking at livestock profits here as a feed price ratio used as a proxy, you can see that livestock sector profits were quite poor the last couple of years. And they were predicted to kind of bottom out here in 2013, but then now kind of rebound. And we are seeing that a little bit, and I'll get into that a little bit more detail. So to get at this a little bit as to what's happening, this is one of the key points to make as it relates to commodity markets. And specifically in our district, I think of corn as, you might think of corn as the S&P for agriculture. And crude oil also shown here just to give a sense of what's happening in terms of production and supplies. And obviously this is strongly related to prices. So what you can see here in the blue bars is the crude oil production back to 2006, and then forecasted forward by the EIA short-term outlook. And you can see here this ramp up from 2011, a little bit higher in 2012, again in 2013 and 2014. The same is true for corn production for very different reasons, but what we've seen is this general decline in corn inventories the last couple of years, some of this coming from very severe drought the last year that resulted in very low stocks-to-use ratios for corn. So when you think about the amount of corn that we have out there available to use compared with the demand that we have for corn, again, this is what's been driving corn prices very high the last couple of years. So now look at the difference, though, between 2012 and 2013. We're sitting here October 3rd, going into harvest in a lot of places, starting to get some of those numbers out. We'll see what happens with USDA again with the government shutdown. That may affect some of their projections about what's happening. But despite what's happening, despite whether there's a slight move down or maybe a slight move up in yield projections, what we're seeing is a strong increase in corn production, and that's shown by the difference in the red bars between 2012 and 2013. And this then translates into prices. And so when we think about where prices are now, this is shown for corn, December futures prices. We're very similar in 2013. We started out very similar as to where we were in 2012. But then the drought hit in late June of 2012 and prices spiked. And then we had crop insurance. We had a lot of other things kick in 2012. In 2013, we started out similar, but now we've started to drift lower. The important point to note on this chart, though, is look at the black line. That's the estimated cost of production. This comes up from Iowa State, and obviously this varies by farm. But the cost of production right now is actually on average higher than where we're looking at the December futures price for corn. The other important point to note here is the 2013 crop insurance price. Right now, crop insurance is set above both of those prices. So again, you could see a situation developing this year where crop insurance still plays a role because most farmers buy revenue insurance, which would insure against both price and yield. So the thing to note here, though, is that going into 2014, that's where we start thinking about risks. Because in 2014, the crop insurance price will be set in February. And if it's set at a price where right now we have December corn futures at $4.50, that's below the cost of production, now you're starting to look at profit margins really getting squeezed. And then the question is, how long can that last? How long can you withstand some of those pressures where your input costs are higher than your outputs? I mentioned the livestock sector, and this chart goes to illustrate break-even prices in the livestock sector for both cattle and hogs. The livestock sector has been struggling, and you can see this by the difference between the break-even cost in red and the cattle price in blue. It's improved here a little bit with the fall in corn prices, the fall in soybean prices. It's been a little bit better for hogs, and part of that has to do with it's a demand side. What we have is still relatively strong demand for pork products coming from China. The beef side has been a little bit weaker there. So I mentioned drought, and for as much of the attention that was on drought last year, it's kind of fallen off the radar of a lot of folks this year, just because when you look at the eastern corn belt, you can see that a lot of the drought has been resolved. But in the western side of things, in the western plains into southeast Colorado and in western Kansas, western Nebraska, it's remained a significant concern. And so when you think about the effect that drought has on pastures and the ability of livestock operators to adequately have inexpensive feed, that's really a problem, and it's forced a lot of liquidation in the livestock sector. And so along with that liquidation, we've seen inventories of livestock start to shift. What's shown here is the cattle inventories for Texas and Oklahoma in red, and then Kansas, Nebraska, and Iowa in blue. This represents about 30 to 35% of cattle inventories in the U.S. The point to note here is the sharp drop-off in Texas and Oklahoma. And you can see here that there's a slight drop in Kansas, Nebraska, and Iowa, but ultimately what we're looking at here is a measure of severity of drought. And that's really because when you think about the costs of feed, it gets a little bit more expensive the further south you get, where they've been experiencing drought for several years as you go further south in Kansas, Oklahoma, and Texas. At the same time, though, we've seen the hog market a little bit different in terms of inventory. So again, there being a demand factor there as well. At the same time, beef processors have been struggling. This chart shows packer margins over the past 10 years, and then the 10-year average for those margins. And you can see the last 2 years, 2012 and 2013, on the beef side, have been very poor. The capacity has been, they've been too much capacity. There's been a plant that's closed down in Northwest Texas earlier this year, recognizing that the demand that's out there for those products is not sufficient to warrant where inventories currently are and the prices that are being paid. Things have rebounded again a little bit on the pork side, and again, this is a demand factor coming from China. That's a big part of what's been driving some of these differences between beef and pork. The question that we get a lot within the Fed, and when we think about the composition of our district, we have a lot of community banks in our district, and the question that we get is, could this transition in agriculture potentially lead to a bust? Are there concerns that we need to be thinking about? Regulators are always talking about what they're seeing going on in community banks. What do their underwriting standards look like? I'll mention farmland prices. That's been a hot topic. Is there any concern that some of this transition that we're seeing in agriculture, where the crop sector is potentially starting to fade going forward, and the livestock sector potentially starting to rebound, are there concerns that we might see a bust? Something equivalent to something that developed in the late 1970s, early 80s. Is there any concern that we're going to start seeing some of those signs? And what I would point out, and again, keeping in mind that agriculture has been operating at a very, very high level the last few years, there's been a tremendous amount of wealth in the ag sector. You'll notice this as you drive down the road and see all these shiny new green combines and tractors out there right now. There's a lot of risks out there going forward. And it may not necessarily be for 2014, probably not for 2013, maybe not for 2014, despite you might start seeing some squeeze. But thinking about what happens in 2014 and beyond, that's where the concerns start to set in. And they could come from a number of sources, and I've listed some of those here, and we'll go into them in a little bit more detail now. On the farm income side, as you can see, incomes have been very high the last few years. 2013 still expected to be near record, the record year being 1973. But you can see going from 2013 to 2014, there's projected to be about a 20 to 25% drop in income. And you can think about what that might mean in terms of your own income if it drops 20 to 25%. That's fairly significant, regardless of the level that you end up at after that shift. At the same time, and what we're seeing here is projections of lower income, we have not yet seen an adjustment in farmland prices. So there's this expectation that incomes are going to fall in 2014, but farmland prices continue to rise, and the question is why? The chart that I've shown here is a cropland value to cash rent ratio. So for those of you that are familiar maybe with the stock market, you can think of this as a PE ratio. So a price to earnings of farmland for compared with cash rents. Historically, this has been in the range of about 15 to 18. The last couple of years, though, we've seen this spike to as high as 32 to 33. So this implies a cap rate of around 3%. And so what this means is that investors would spend potentially $32 for every dollar of revenue. And when you think about where this has been historically at 15 to 18, and keeping in mind also that the S&P 500 is about 15 to 18, the question is why? What's going on? Why would people be spending this kind of money to invest in farmland? And not only why, but then the follow-up question to that is that sustainable? Export demand has been a big driver. As it was in the 1970s, export demand has been a big driver to farm incomes. There's been a lot of questions, though, about what that looks like going forward. What does demand look like from China? We've seen signs of some potential concern coming out of Chinese growth. You can see here in this chart that ag exports overall have been increasing quite dramatically the last several years from 2006 to 2012. And shown in parentheses here, you can see that the Chinese share of U.S. ag exports actually doubled from 2006 to 2012. But now, looking at 2013, there's some signs of softness. So you see in the red, representing the Chinese share of U.S. ag exports, that there's a dip there. So there's some questions about how much we're going to get from export demand going forward. At the same time that we're seeing some concerns in export demand, we're seeing a ramp up in global competition. So what this chart shows in the yellow bars is the U.S. share of world acreage over the past 10 years. And you can see the general decline, red here from the right axis. And this is a share of acreage. What's shown in the lines then is on a regional basis, those countries that are ramping up production. The U.S. is blue. And so as you can see in the blue line, it's been relatively flat since 2000. We have not, although we've expanded a little bit, we haven't expanded nearly to the level of what's going on in places like Ukraine and Brazil and Argentina, where there's just been a lot of acreage coming on and a lot of investments. We had a conference this past summer, and a guy was talking about investments in Ukraine, investing in thousands and thousands of hectares in Ukraine, despite what you might think of as a relatively poor infrastructure and concerns in terms of financing operations and what corruption might look like. There's a lot of investments going on overseas, and the question is how much longer will the U.S. continue to be the low-cost producer? One of the other aspects of demand, I mentioned exports, is ethanol. Ethanol is a huge component to corn right now and representing a fairly inelastic demand. Where we're at right now, though, this chart shows red is ethanol production over the last several years, and blue is what we refer to as a blend wall. And this blend wall is essentially 10% of gasoline consumption. When you go to fill up your gas tanks, most fueling stations will have ethanol or the fuel blend is 10% ethanol. And this comes from a mandate that was issued several years ago that says by 2015 we need to be producing and using 15 billion gallons of ethanol. And that represented at the time the forecast of 10% of gasoline consumption, which was expected to be 150 billion gallons. But what's happened is that people are driving less and they're driving more fuel efficient vehicles, and so the gasoline consumption and the projections for gasoline consumption has fallen. And so when you think about the mandate going forward in 2015, gasoline consumption expected to be about 135 billion gallons means that the most that we can produce, with some exceptions as it relates to higher blends, is about 13.5 billion gallons of ethanol is the most that we can produce and use in our transportation fleet. But the mandate is set at 15 billion gallons, and so what you have here is a gap. You have a gap that we cannot actually use enough ethanol to meet the mandate that's required for 2015. And so there's questions as to what happens to renewable energy policy. Do they start to write down what the mandate is, or do they start to think about the policy from scratch? There's a lot of questions about where this is at, but what we're at right now is we're getting to the point where we're either at the blend wall or very, very close to the blend wall, meaning that we literally cannot produce enough ethanol going forward to be able to meet the mandate, with some exceptions as it relates to higher blends and credits from carryover years. One of the other aspects and questions that we get when you think about whether this income or whether this transition may be a bust going forward is comparisons to the 1970s and 1980s. The chart here illustrates returns to farm operators, so you can think of this as a measure of profitability, and capital expenditures over the past 100 years. The portion of this chart that really stands out is the mid-70s and early 80s. And you can see here again that point in 1973 where you see the jump in income. And so this was the peak of farm profitability, and then export markets started to collapse after that, leading into the 1980s and the farm crisis. So what you have here is a sharp downturn in income and returns to the farm sector in the late 70s going into the early 80s. But the point to notice is not so much what happened with profitability. We can understand that. We understand what happens with supply and demand. The point is to note what happened to investments as we started getting the downturn in income. And what you can see is that even after income started to crash, it was 4 to 5 years before investments peaked. And so what happened is that you had a sector that was recognizing maybe this is a short-term blip. Maybe this is a one-time anomaly. Maybe I need to think about my long-term operations. In order to be a viable operation, I need to think about my investments over the long term. And so you keep making investments. You keep leveraging up. You keep thinking that this is going to turn, and eventually it doesn't. You get to a point where you're over-leveraged. Your debt to assets are out of whack, and all of a sudden you start seeing bankruptcies across the country, and it becomes something fairly systemic. This was the 1980s, and now there's questions about whether or not we're seeing something similar today that could be concerning going forward. When you think about where incomes are right now, they've been very, very high, again, as they were in the 1970s, but they're projected to fall going forward. The question is what happens to debt? Will farmers recognize that this is a concern and that there are things that presented problems in the 1980s with over leverage? Or is this something that will develop into a leverage cycle where farmers start to use debt to finance operations and capital investments, looking at their viability as an operation going forward? So there's a lot of things to monitor here then as it relates to debt. When you look at these last couple of data points, you can see that investment has been edging up, but relatively slowly. There's concerns out there that some tax policies may promote investment going to the end of 2013, and thinking about what that means for financing and debt going into 2014 at a time when incomes are turning down is one question. I'll mention here also interest rate risk, and this chart was shown from the previous speaker as well. So thinking about what the Fed balance sheet looks like, and again, going back to 2007, a balance sheet of slightly less than $1 trillion, and now toward the end of 2013 could be as high as $4 trillion. Again, the Fed had decided a few weeks ago to continue its large-scale asset purchase program by purchasing $45 billion a month in treasuries in addition to $40 billion a month in, or I'm sorry, $45 billion in treasuries and 40 in mortgage-backed securities. So this has been continuing for some time now and being at this lower bound of interest rates. But there's been widespread recognition, and it's been mentioned, that interest rates in the Fed balance sheet can't be sustained at this level. And so going out and going forward, we think about where interest rates might be headed. And there's really no alternative other than eventually interest rates start to rise in order to get this balance sheet back to something that was a more historically normal level. So at the same time that you have in 2014 this possibility that farm incomes may be turning down, you have a possibility that farmland prices may react to some of this, some of the lower crop prices. I would mention also that farmland is used as collateral on a lot of other loans. So if you do get an adjustment in farmland prices, think about what that means in terms of your other lending options. At the same time that you have concerns about what the export markets look like, what concerns about renewable energy policy looks like, what happens to debt going to the end of 2013 into 2014. There's a lot of risks out there, and again, at the same time that you have this possibility of higher interest rates. We ask a question. We have one of the publications that we put out at the Kansas City Fed in Omaha is a survey of agricultural credit conditions. And in this survey, we ask various questions as it relates to farm income and repayment rates and just general profitability of the sector, any concerns in the banking sector as it relates to agriculture. And from time to time, we ask special questions. And the last question that we asked on the survey in the second quarter was what ag bankers really felt was contributing to this boom in farmland prices. And listing out several options, it's interesting to note from that survey that income expectations actually factor into about the fourth or fifth reason as to what's supporting farmland prices. The wealth of the ag sector and low interest rates are really the top two, in addition to a lack of alternative investments. So if you're a farmer and you have, if there's a tract of land that comes open next to you, you've had a lot of money sitting around from the last few years. There's been a lot of cash there. You're thinking about this low interest rate environment and what it looks like to purchase farmland. You think about that as an option relative to all the other investment options, and this is what you know how to do. This is what you were born doing, perhaps, and this is what you want to do for the rest of your life. You're going to buy that tract. So even though we see this downturn in income, and there is really widespread recognition that there's concerns in the ag sector about what profit margins might look like long term, we still have not seen this slowdown in farmland prices. In fact, some of the auctions that I've seen here relatively recently have been very strong, especially for quality farmland. And when we think about Kansas, you think about Nebraska, there's a very high amount of irrigated cropland. And so if you're one of those that's fortunate to have water rights on that land and you have irrigated cropland, you're guaranteed a revenue stream from what's relatively high crop prices right now, albeit costs have also adjusted up. And so again, there's really been strong demand for irrigated cropland throughout the Western Plains and especially non-irrigated cropland throughout Iowa. So with that, I will offer some concluding remarks. What we've seen is a modest transition, recovery in the economy, and a transition where some sectors have started to perform a little bit better and some of the others have gotten a little bit weaker. And commodities in general are driving what I would call a transition in agriculture. Specifically, what we're seeing is a shift in crop sector profitability, a potential shift going forward. It hasn't been there yet. And then a return to some profitability in the livestock sector. Again, there's questions about what demand looks like on the beef side. You go to the supermarket, you'll see that retail beef prices are very, very high. In some cases, wholesale beef prices haven't quite met that retail increase. But in this transition where we see stronger livestock profits potentially and lower crop sector profits, there's a lot of risks that are out there. And so to summarize those, you look at falling farm incomes. You see farmland values that I would tend to think might not be sustainable at a level of a PE ratio of 32 to 33. Export markets are another one. We've seen the weakness in Europe is not just confined to Europe. They're also a main trading partner for China. And so when China has its own growth, it's dependent on what happens in Europe. So you see weak markets globally, that affects ag exports. Specifically thinking about what some of the mechanisms are to avoid this downturn, and would mention that working capital is really the #1 thing to be thinking about if you're a farming operation. So you think about leverage and you think about what some of the weakness might look like. Keeping those strong levels of working capital is really a way to ensure some sort of buffer against these risks that are out there.